Good afternoon and welcome to the Cityscape Intelligence webinar on the impact of COVID-19 on the UAE and KSA market. I'm your moderator, Tanisha Naidu, Head of Content at Cityscape, and in this afternoon session, we deep dive into the effects of this pandemic on the economy and the real estate sector. As the world contends with the rippling effects of COVID-19, questions continue to arise around humanity's new reality, with one particular question plaguing the minds of many: when will this end? But perhaps that's not the question we need to be asking as a real estate industry. We should be asking, how do we continue? And that's exactly the question we want to address today. COVID-19 has created an unprecedented challenge for the economy and the real estate industry. And this means that there will be a seismic shift in the way we interact in our physical spaces and the way we shape our built environment and in the way we invest in real estate. Our speakers for this afternoon will give you an analysis of what's happening in the economy and the commercial market in the UAE and KSA. They are Simon Townsend, Senior Director and Head of the Valuation and Advisory Business at CBRE, and Dr. Chris Payne, Chief Economist at Peninsula Real Estate. Before we start this webinar, I would like to invite you all to submit your questions to the panelists in the question box located on the right side of your screen. We will try to answer them during the audience Q&A at the end. Now, kicking off our first session is Simon Townsend. We'll be looking at workplace trends today and in a post-COVID world. Over to you, Simon.
Thank you, and hopefully everybody can hear me. Good afternoon, everybody, and firstly, again, thank you to Cityscape for arranging this webinar. I think one of the things that we find when we are in a period of uncertainty, when the world is looking a lot different to what we thought it would, the more open discussions we have and sort of engagement with market colleagues and participants, the clearer hopefully the picture becomes for all of us. So thank you for that. By way of introduction, as mentioned, I'm Simon Townsend. I lead the strategic advisory teams here for CBRE. Most of you know who CBRE are, so forgive me, I won't give you a big in-depth introduction. I mean, I think you've worked with us either locally, regionally, or from one of our 500+ offices. And really, what our role is here today is to look at how the real estate world is changing and what we're seeing both today and in a post-COVID world. The purpose is not to give you an in-depth market analysis. I mean, that's a sort of a webinar in its own right, which would fill up all of the time. We'll touch on that, but go through some of the trends that we see and what that really means for us. And I think, I've been in the region for around 20 years now. And one of the things that, I'd say I've seen a lot of changes, both from a regulatory standpoint, whether it be the introduction of freehold, whether it be the changes to the ownership of companies, or whether it be the way that companies can trade through special economic zones and others. I've also seen a lot of physical changes. The Palm, the Burj Khalifa, the King Abdullah Financial District in Riyadh, and a majority of major infrastructure changes that have obviously positioned ourselves in a very different place than we were when I first arrived. All of these changes, though, have seen other external challenges: global financial crisis, oil price challenges, geopolitical challenges, and now we're faced with another one, the COVID effect. And I think one of the things that we're going to look is, what does that mean for us? So as we move on, and forgive me, I'll just share my screen. Hopefully, is that something you can see? I hope so. So from my point of view, I say I've been here 20 years. I've seen a lot of changes, and one of the forgive me one second just while I make the screen move. Here we are. So hopefully that's visible for you all. So what I'm going to do over the next 10 to 15 minutes is I'm going to give you a very high level overview of the market, and I say high level because, as we say, it's a webinar in its own right. I'm going to talk about some of the workplace trends, and then importantly, what does that mean for real estate? And what do we do next? So we will summarize at the end. There'll be some questions as was mentioned, and certainly hopefully be able to assist in answering some of those for you. So as we look at the workplace, one of the most important things for us is the interaction between the employee and the real estate itself. And as we move forwards, we'll see a lot of the impact in the trends are highlighting how perhaps these will change over time. But I think, there were changes happening before COVID. It's not as if, it was completely dark and somebody has turned a light on, or the inverse. There were a lot of things that were changing before. I think what we're seeing now is a lot of the changes required have been fast tracked. And as we look through the 6 or 7 different trends that we've highlighted, you'll see some of these look familiar to you, and you'll have heard some of these and have maybe looked at some of these as we, up to this point. But I think now we're really focusing on how we can implement these for the future. So as I say, I'll give a very high level snapshot of the market. I think, one of the things I would say, and one of the questions that we're always asked, I think locally, regionally and globally, is, well, if the markets are in a state of uncertainty, I assume this means everybody's going to take less space. And I think I want to deal with that at the very beginning. And I think it's not necessarily the case that, the two are linked. And what I mean by that is, it's important to remember that the way we're going to use our office space, the way we're going to use our commercial facilities going forwards potentially has changed. And as a result of that, as a result of perhaps space requirements per person changing, the utilization of common spaces, communal spaces within our own demise, what this could mean is the inverse is actually true. The inverse being we may need more space rather than less space as we move forwards. So that's something that, again, we should keep in mind. I think the market misconception that everybody is going to take less space, I think is something that is yet unknown, but certainly, the house view is that that may not necessarily be the case. So as we look at the region, as you all know, there's, some very strong government projects that are in place, particularly in the Kingdom, looking at Vision 2030 and how that plays a major part in changing the landscape of Saudi Arabia. And I think the processes and procedures that were put in place around that has really provided the platform, not that it's hedged against what's happening, because there are, material impacts there, but certainly has provided that platform for growth for the future. So we'll have a quick look through these sort of 4 headings, each one behaving, differently, but with some of the same underlying tones, and the same underlying tones being that, for obvious reasons, the market is in a slightly negative place to where it was at the beginning of the year. I think the commercial market habits are changing. Some of the large occupiers that had operations ongoing, those are still happening, but the relocation and the changes into office space, that's perhaps gone back to the drawing board. People are looking at how much space will they need in this new world, what that space will look like, how will they use that space, and more importantly, where should that space be? So that's something, there's a lot of analysis going on around there. Will people stay in the same building, for a lower rent, perhaps? Will they move to a new office space where concessions are perhaps provided by owners and others, where they could move net for the same rental? These are discussions and debates that are ongoing. And I think at the moment, the impact of that is not yet visible. The retail market, again, we all know in our respective markets that a lot of the shopping malls were closed. Retailers haven't been able to open. There have been lots of publications in the or comments in the public domain from retailers. I think the relationship between landlords and tenants has been important. It's perhaps grown stronger in a number of instances where concessions may have been given, leases may have been restructured to facilitate the ability to grow. The true impact of the impact on the real estate market from a retail point of view, we believe we'll see clearer from the end of Q3. I think the important thing to say, though, is with malls opening and new malls still under construction, with construction some close to completion, we are seeing a focus again for new retailers coming in, particularly those from the Asian subcontinent, and looking at entertainment around retail as a big concept. So again, the green shoots are starting to be visible in the retail space, but the true impact not yet seen. Hospitality today, obviously an important day in Dubai with tourism sort of opening up again. We hope this will provide some respite to the hotels that have sort of been closed. F&B is now open or opening. The rules are changing around that. One of the biggest challenges, of course, is in the Kingdom, with an underlying reliance on cultural and religious tourism. The restrictions on the number of tourists that can go through this year is significant, and we think there will be, as we go towards the end of the year, quite a noticeable shift in the positivity around that space. But it is, as we look at the Vision 2030 and we look at the plans within the UAE, hospitality does play a major part. So whilst this will be some short-term suffering, we do see that in the medium and long term, this will come back to being one of the asset classes of choice. There's lots of activity in the residential market. I think there always is when markets change. People either downsize because their personal situation has changed, or in some instances upsize for the same rents. So we are seeing lots of tenant movement in the rental space. I think in the freehold space, both across the whole of the region, the disposals are getting more difficult. So developers are having to prioritize incentives, payment terms, concessions, and others that they give to try to keep that market flowing. Again, we do expect a little bit of negativity, but with some positivity coming in the short to medium term. So now we look at perhaps the main focus of today, and the main focus really is some of the workplace trends that we've seen. It's important that obviously that we learn from the past, and what we learn there helps us shape the future. I think that one thing that's important at the moment is that the challenges we have been presented with now mean some of the lessons that we've learned historically, they're not actually relevant anymore. Some of the data, some of the the things that have happened that we try to draw analysis from, actually it's not possible with the COVID effect, as we like to call it. You mentioned at the beginning some of the questions that we need to answer. I think one of the questions that we're often asked is, what do I do to protect the future of my real estate? And I think as the world is returning to work at different times, we are learning lessons from sort of our global colleagues, particularly those in Asia who perhaps slightly ahead in the return to work. And I mentioned that we learn from the past. I think at the moment we're learning from the now, and we're looking what's happening across Asia. What are the trends that are coming out? How are companies reacting to going back to the office? How is the human interaction with the workspace changing? And we're learning lessons from that, which hopefully will be able to translate into creating the environment that we need here to grow and create the future workspace. So CBRE has identified in one of our recent reports, and the report Workplace Trends, the link for the report is at the bottom there. I appreciate you probably can't click, but if you went through the CBRE website, you'll be able to find the report. And we identified 7 trends within that. And I'm going to go through the majority of those as we speak just now. But I think one of the most important ones, and one that, as many of you will be sitting in your home or a Starbucks or whatever it is, I think one of the most important ones we'll talk about is remote working and the way that's changing what we do. So when we look at the work environment, I think we all probably accept that our environment has changed. We've gone from, for those of you that are old enough, we've gone from office space full of cubicles to private cellular offices, then open plan was what we needed, and then flexible working. I think all of that is changing, and the environment that we work in is becoming a key component in retaining valuable talent. And that's an important thing to reflect on, because the talent pool or the labor market within which in the markets that we work is quite tough. And as companies, keeping our key assets, which are our employees, is very important. A recent study by Glassdoor, which we've had sight of, across all of the companies and all of the employees they interviewed, 85% of those employees were disengaged. Now, it becomes very difficult to retain a disengaged employee. So keeping the work environment in a way that enables employee retention, enables the companies to be efficient, is something that's going to be a key focus and a key trend as we go forwards. The next one is something that I struggle with, and again, it's an age thing. I'm certainly not a millennial or a Generation Z, but as we look at this, the new modern companies are actually being managed. Many have actually been created within the millennial and the Generation Z period, and the way that these companies are evolving needs to embrace that technology. In the wake of COVID, many of the firms that have been hesitant to adapt this technology are almost being forced to comply, and to comply very quickly, being able to adapt. And we look at future workspaces, whether it's AI, whether it's this 5G and everything else, The physical workspace, hugely important, but the social and smart way of working is going to really drive how we use that space. So, adapting with technology, having a tech-enabled future workspace is going to be key, one of the key trends we see as we move forwards. Now, clearly, maximization of space, you would think is common sense. We obviously want to get the most efficient use of the workspace that we have. But I think as more and more of us visit our offices less frequently, we have to look again about how we use that space and what we want to do when we're there. The creation and adjustment of collaboration space and more areas where teams can get together, noting the social distancing and other requirements is going to be a priority. Maybe less desks, maybe there'll be less physical single workspaces and more collaboration areas. And I go back to a comment I made about taking office space. There was a trend of firms decreasing the amount of office spacing. They were coming together, consolidating their holdings into a single asset, creating more efficient spaces with smaller amounts of space per person. I do believe that the opposite trend is now going to happen, and potentially layout changes will mean that either the space requirement will be the same or marginally more. We're looking at smart buildings, maximization of space in the work environment. If you look at all of three of these together, there are examples of good quality buildings that are coming out in the market, innovative technology, innovative space, and evolving environments. And I think in the CBRE report that I mentioned, we have a case study on one of those buildings located within the DIFC, the ICD Brookfield building. And I would suggest it's well worth having a look at both the building, but also the case study to see how that building has adapted to these trends. Again, before the pandemic, there was already pressure on global corporates and occupiers to increase the employee experience. One of the ways they were doing that were creating more amenities, more facilities within the location of the office. I take DIFC, I take King Abdullah Financial District in Saudi Arabia. One of the key things that's been focused on there is providing the additional amenities to office occupiers, the F&B, the wellness, the hospitality, the government services, the medical, all of these things to enable people to maximize the use of their day. They can do all of their work and play, as it were, within the same environment. But it's not just the working environment. We have to also look at the community and the movement of people within the building. We look at the buildings that we all work in at the moment. We note small, congested common areas, queues for lifts at certain periods of time. With social distancing and others, the movement of people from their car park to their desk is proving very challenging. So when we look at the future of buildings, it's not just our own demise that's going to change. The internal characteristics and the movement of people within those buildings, the choreography of occupiers from car through desk is going to change and affect significantly how we design buildings. The next two are the two that I think we can probably all relate to at the moment, and I look at these two as being sort of interlinked. I think and there's a difference here I want to make. Work-life integration and work-life balance are two different things, and for me, we're here looking more at the integration of the two rather than the social side. But I think what it's interesting to see is there was a study in the US where they looked at, since 2004, how has your working life changed? And there's been a 38% growth since 2004 in the number of people that conduct some of their work outside of the office. That was telling, but I think the most telling statistic was over that same period, and this was carried out pre-COVID, I must stress, but carried out over that same period since 2004, more than 79% of the people surveyed indicate that they do most of their work outside of the workplace. And I think, for those of you that are based in sort of many of the major hubs, whether it be DIFC or parts of Riyadh, parts of Jeddah, trying to find a table at Starbucks is testament to that. It's full of people remote working, a laptop and empty cups of coffee. I think how we're working and where we're working is being hugely important. And I think one of the things here is that companies are going to have to look at providing the network, not just physical, but also technology to enable people to carry out this work remote. You sit on the aeroplane at 30,000 feet you're still getting access to Wi-Fi and carrying out as much work as you would, maybe slightly slower, but as much work as you would in the airport lounge. So we're having to adjust to that. And when we look at working from home, I have to be honest, I was one of many that, when it was first announced, thought this was going to be very difficult to adapt to. I think many of you will have had meetings, conversations where there's been a common theme where people are genuinely surprised how quickly we've all adapted and how seamless the transition into remote working has been. And just internally within our London business, or within our UK business, CBRE carried out a home sentiment survey in early May, bearing in mind the lockdown was in full force at its strictest in the UK then. And 84% of the people within that 2,500 sample set, 84% of the people thought that there'd either been a neutral or a positive impact on their sense of productivity. And I think that's something that we're hearing a lot. People do genuinely feel that they've been more productive working in this remote, sort of homework integrated approach. When asked how many people want to come back to the office permanently, less than 40% of the people thought going back to the office 5 days a week was going to be an important part and change the way they work. So again, I think it shows that the way that we're going to work has changed potentially for a generation. So what does this mean? And I appreciate in the interest of time, I'll sort of skip through, but I think there has been a lot of physical change. I go back to the question at the beginning, what should I do to protect my real estate? And I think, one of the most important things that you'll hear is words like agile working, flex working, fluid workspace. These are pretty much in every sentence, in every discussion that we have now. The word agility conjures up many different things. And to me, the word agility implies the ability to adapt to continuous change. It also suggests a never-ending need to twist and turn with the wind and whatever is thrown at us. And I think, as the martial arts legend himself, Bruce Lee, has said in the quote that you hopefully can see, the stiffest tree is most easily cracked, while the bamboo or willow survives by bending with the wind. The key for our real estate as we go forwards is to be the bamboo or the willow. We have evolved. We need to capitalize on this technology revolution. And I think you'll all have seen His Highness Sheikh Mohammed's Dubai 2021 plan, where he goes into press and expands on all of us that we need to go from an industrial-based workforce to a knowledge-based sector. To do that, we need to keep this agility. And this isn't just unique to Dubai and his vision. Within the 2030 vision in the kingdom, the idea is to transform many parts of the kingdom into smart cities with smart buildings and smart occupiers, and technology and the real estate workforce and the real estate workplace is going to be fundamental to how we achieve that. So what next? What does this mean for us? How do we get there? I think I go back to the question at the very beginning. What should I do to protect my real estate future? Well, I think with all of the challenges that we're seeing, a lot of the trends that I've skipped over quite quickly there, but a lot of the trends, by adapting those, by looking at being agile, by looking at creating the flexibility, creating a focus on our employees, the workspace, retaining employee engagement, by creating all of those, we can create the workplace of tomorrow today. The most important part, though, is we mustn't forget the real estate is important. The way we use the real estate is important, but what's really driving our business is our employees and the way that they interact with our business. So keeping that in mind, linking the human and the real estate as we go forwards is going to be one of the most fundamental things to enable us to hedge against some of the challenges that are coming forwards as a part of COVID. I appreciate I scanned through very quickly. There's a lot to fill in a 10 to 15 minute sample set. But as mentioned, the reports that I've referred to can all be found on the CBRE website. We have a COVID section in our global website with a lot of resources about how the rest of the world is reacting, what we're seeing in Asia, in Europe, in the US. And for those that are interested, I recommend having a look through that. From my point of view, there's certainly time at the end to answer questions. I think when we'll return and what it will look like, I think your next speaker, Dr. Chris, is much better placed than me to respond to. So thank you all for your time. Hopefully you saw the presentation, you could hear clearly, and I look forward to participating in any questions as we reach the end. Thank you all.
Thank you, Simon. Once again, if you have any questions for Simon, please submit them in the question box and we will answer them at the end of the webinar. I'm already getting quite a few interesting questions, so I'm looking forward to getting to that. Next up is Dr. Christopher Payne, Chief Economist at Peninsula Real Estate, who will discuss the GCC economy and real estate outlook, looking at KSA and UAE. Over to you, Chris.
Thank you, Tanisha, and thank you everyone, and good afternoon. Thank you for coming onto the webinar, and thank you for Cityscape for arranging. Right, I'm now going to share my screen, and hopefully, yeah, hopefully everyone can see that. So I'm going to talk today about the GCC economy and the real estate outlook. And particularly focusing on Saudi Arabia and the UAE, as you can see. So one of the things I'm going to start by really saying is something that Simon said, which is that COVID-19 is actually really exacerbates and fast tracks some of the trends that we've already seen over the last few years. Now, I really like those two words that he used, so thank you, Simon, for saying them. And really, the reason why I'm saying that up front is because one of the things that I will talk in detail about COVID-19 and these economic impacts, but I think it is really important to understand that to start out, we have to realise what's been going on in the real estate markets in the last few years, and that once we do that and understand that it's really been a problem with insufficient demand, then it actually becomes easier to think about what COVID-19's impact will be going forward. So stay with me. I'm going to start off with the first few minutes. I'm actually going to give a bit of history pre-COVID-19, and then once I've done that, hopefully you'll all see how that then really helps us understand the post-COVID-19 environment. So without further ado, let me begin by pointing you all to the bottom left-hand corner, and what you'll see there is two lines in the chart: UAE residential year-over-year real estate prices and real non-oil GDP growth. And I hope you can see clearly that there is a very high correlation between these two lines. And really what at the core of our analysis, of Peninsula's analysis, is that, as I said, the real problem in the last few years has been about insufficient demand and a weakening of demand growth. Now, a lot of people, obviously, we all know there's been a lot of talk about excess supply, but obviously excess supply and insufficient demand are two sides of the same coin. What we're arguing is that it's really what's been creating excess demand is actually a falling away, excess supply, I should say, is a falling away of demand. So, and that proxy is non-oil GDP growth. And I'm going to try and evidence before talking about COVID-19 that there is causality more than correlation between these two lines. Firstly, just on the concept of supply. I mean, if you see in the bottom right-hand corner, some of you will recognise these old-fashioned demand-supply curves. But what you will see is that if it just been an issue of adding supply, then we would have seen prices decline, but an increase in the quantity of transactions. The reality is in the residential market, at least in Dubai, where we have the data, we've seen a very significant decline in residential volumes. And that really can only be explained, if we believe anything about Econ 101, by a downward shift in the demand curve. So why has this occurred and what does it mean going forward? What I'm going to quickly run through is this point that oil prices fell at the end of 2014, as we all know. And because governments in the region, 90% of their revenues came from oil and gas, we saw a very sharp move from large fiscal surpluses in the region to large fiscal deficits. And because of that, governments rolled out significant fiscal controls. They didn't turn on the printing press. We are attached to our currency stability. It anchors the region, economically speaking. But those, so we had conservative and appropriate fiscal controls, and those fiscal controls led to a decline in demand, economic demand, which, as I will show, fed through into the real estate market. So let me just focus very quickly on these two charts, just to show that for each country, there are 3 bars. One is the surplus as a percent of GDP in 2013. One is the deficit as a percentage of GDP in 2015 or 16, and then what had been achieved by deficit reduction by 2018. And you can see, for instance, in Saudi Arabia, a deficit of 15% in 2015 had become a deficit of 6% in 2018. And the UAE at the general government level had eliminated the deficit by 2018. How did they do it? Well, you can see on the right-hand chart that it was helped by an increase in oil prices, obviously, but particularly in Saudi and the UAE, most of the deficit reduction came from fiscal control, i.e. either broadening the revenue base or cutting spending. So we've seen some real fiscal activity in the last few years in the region. And again, this chart really shows on the left that there's a very high correlation between the amount of spending power that's been taken out of domestic economies and the slowdown in non-oil real GDP growth. So that's really the story of the last few years. And you know, it's a pretty obvious one. If you take spending power out of the economy, the rates of growth slow, but it's probably not that one, not a story that's been as well understood as it could be. What does this mean for real estate? Okay, and I will then go on to COVID, but as you'll see in the top left-hand corner, we have some data on Abu Dhabi, which shows that there's a very high correlation between real non-oil GDP growth and changes in the annual population. Obviously, when the economy slows, people lose their job. That's the same pattern we see anywhere in the world. But in this part of the world, of course, losing your job often means leaving the country. So rather than seeing unemployment tick up, we see a slowdown or even a contraction of the population. And it's that contraction of the population that, of course, directly feeds into that downward shift in the demand for real estate. Okay, so that's why, of course, supply has exacerbated in some cases the downward shift in prices, but it's really very much been a demand factor as well. Now, that said, before COVID came along, what were we forecasting? We were forecasting, if you look at, say, the bottom left-hand chart there, we were expecting non-oil GDP growth to kind of trend around the 2% level, which, given, let's say, 5% decline, increases in supply, suggested maybe a small decline in 2020 residential real estate prices, maybe in the sort of 2, 3, 4% level. We were therefore expecting the market to stabilise, but without the fiscal taps being opened, which we were never expecting anyway, without the fiscal taps being opened, the upside to real estate was limited. It was more of a case of stabilisation. So that's why, now I'm going to move on to COVID, but perhaps already you can see that the causes behind the slowdown in terms of fiscal control and demand are only exacerbated by COVID. It doesn't really change the story greatly. So let me talk for the rest of my section about COVID. So firstly, you know, creating GDP forecasts in this kind of environment is nigh on impossible. Economic models are based on what you know from the past, but seeing as we didn't know anything about COVID and its impacts, it's difficult to factor them into the model. But you can see that we've made some very broad generic assumptions about private sector consumption and investment, and it kind of chucks out some forecasts for non-oil GDP growth around about a contraction around 5% in both Saudi and the UAE. And they're reasonably in line with forecasts that others have made. And you can see from the charts that obviously, you know, Saudi's economy will shrink for the first time, at least since the millennium, and that, you know, UAE's contraction will be greater than what we had during the financial crisis. This again really just gives you more indication of the assumptions we've made across the different expenditure categories of the economy to come out with this forecast. And the bottom table is really just a mathematical exercise. It says, well, look, if we look at the economy as a different set of expenditures, sectoral expenditures, how does that map onto sector output? Given the aggregate expenditure equals aggregate output. So again, it's just a mathematical exercise. It gives you our best guess, if you like, about the different what it means for certain sectors. But I think, in a sense, whereas we can be less clear about the GDP effects at the moment, we can actually be much clearer about fiscal deficit that's implied in 2020, and again the collapse of revenue because of the collapse in oil prices. Okay, so we have fiscal deficit forecasts for Saudi Arabia and the UAE of about 10 to 14%, and I should add that that's based on an average oil price of about $40 per barrel. We've tried to incorporate all the fiscal policy announcements that have been made and made some other assumptions. And for Saudi, it does include the tripling of VAT and the elimination of living allowances for Saudi nationals that work for the government. So we've tried to incorporate as much information as we can. And as you can see, yes, from this chart, again, you know, we're looking at very extreme deficits that both countries have done so much to sort of get under control in the last few years. And there's some sensitivity analysis on the right, depending on what you think the average barrel of oil is going to be. As I said, I think $40 is turning out to be reasonably accurate. We have some similar forecasts for the rest of the GCC. I'm not going to spend too much time on this, but essentially, no surprise, it's a similar story across the whole of the GCC. So what does this mean? Okay, so this is where we can start talking about what it means for our economic outlook and for what it means for real estate as well. I think the key point about Saudi Arabia and the UAE, that there's sort of good news and the bad news. The good news is that these countries have very, very significant amounts of sovereign financial assets, so net sovereign wealth, if you like. And therefore they are able to cover these deficits with the savings that they have. But it's very painful. So if you look at the bottom row of the table, you'll see that in our best estimate of what we think the deficit's going to be and of what we think sovereign wealth funds are worth, we reckon that sort of the UAE may be looking at using up, say, 4% of its net sovereign financial wealth this year to cover the deficit that will arise because of COVID. And we think that Saudi Arabia may be looking at taking up 16% of its sovereign net financial wealth. Now, that's really painful. It's coverable, it's manageable, but it's painful. And if you wanted to understand why Saudi Arabia have acted to increase VAT, are eliminating certain subsidies, this is the reason why. It is this 16% number that's behind it. I mean, the Saudi government want to use that financial wealth in order to invest in their economy and diversify their economy. It's painful for them to have to use it to cover a deficit, and I think that's the reasoning. It's trying to maintain as much wealth as possible for future purposes rather than using it to cover a deficit that's behind some of the actions that we've seen in the last few years. So they're taking a conservative fiscal approach, I think, is one way of looking at it. And there's also a conservative monetary approach here as well, which you can see that, in terms of, if you look at other countries around the world, in terms of, you can't do QE here because there's no domestic sovereign bond market. But most of what Saudi and UAE have done is ensuring liquidity to the banking sector. But the fiscal measures that they've made have been relatively small compared to say the US, where we're looking at a 15% plus additional deficit because of COVID, but of course the US has the Federal Reserve and they just buy back the bonds that they issued and they monetize it all. So again, it's a conservative monetary approach that is focused on stability, focused on maintaining that currency stability that's such an important anchor to the region. And this is actually my last slide. What does this mean for real estate? I think everything that we have seen shows and points to, as I said, this conservative approach that's being taken in the region to managing the economy. So we haven't had a fiscal splurge, and that opening of the taps hasn't happened because of the need to preserve sovereign wealth, and we don't expect that to change. I mean, if you're willing to put up VAT in 2020, that is evidence enough of your commitment to establishing fiscal sustainability. So we don't expect, in a sense, and this is why I come back to the fact that COVID exacerbates the situation that we were already foreseeing for real estate in the region, which is that that we're less likely to see an opening of fiscal taps in the next few years because of COVID, but we didn't really expect to see one anyway. Economically, yes, 2021, just because we're coming from a low base, we'll see higher rates of growth than we saw in 2019, but the economy will still be smaller or no bigger at the end of 2021 than it was in 2019. We may, looking at this year in our own modelling, it's possible that, if you were for seller of real estate now, you'd expect to take potentially a double-digit discount on what you were looking at January 1 this year. And given the way that our own economic modelling works, we may see, therefore, a bottoming of the market next year as at least we begin to see demand picking up next year. So this year may be the worst in the cycle and things stabilise or slightly improve next year. But from a sort of a 3 to 5 medium-term scenario, fiscal sustainability is still the order of the day. Fiscal taps are unlikely to be opened. And, in any country around the world, it's difficult for the private sector to flourish in that environment. It's going to take time for supply side reforms to work. And in that context, a stabilising market is what we're expecting, rather than either a steep rebound or the sort of strong variability that we've seen in previous real estate cycles. So thank you very much for listening. Please visit our website and see some of the research that's on there, and our Instagram account. I will actually, if I can, I think I'm going to stop sharing the screen now and hand back for Q&A. Thank you very much for listening.
Thank you very much, Chris. So I'm just going to ask Chris a few questions. Let's just break down what you said. You gave us quite a well-rounded look at So let me just repeat that. You gave us quite a well-rounded look at Saudi and UAE economic activity. What impact do you think this will have on developer and investor sentiment specifically?
Well, I think not a great one, quite obviously. I think that, if investors and developers are looking at projections for economic growth, then I think that's obviously going to, it's going to create negative sentiment. There's absolutely no doubt about that. Of course, that does mean that the cyclical addition of supply will be quite muted as things turn around. So in terms of it as an investor perspective, that may portend quite sort of green shoots. Arguably, from a developer perspective, of course, it's very problematic for developers because developers develop. That's what they do, and it's going to be difficult for them to manage this cycle going forward. But as I said, the key issue, and it goes back to that chart that covered Abu Dhabi, is that obviously there is a correlation between recession or slowing economic growth and population. And as we well know, in the UAE, a lot of prominent officials have talked about population shrinkage, and I'm sure people listening to this webinar know of people who are leaving or planning to leave. And of course, that's the real transmission mechanism between the economic environment and real estate this year. And of course, developers looking at that will be concerned, and it's going to make them reappraise their own assumptions built into some of their 5-year planning.
You mentioned that, yes, we don't have a crystal ball, and while this is the biggest social and economic disruption in recent history, do you think it's naive to believe that once a vaccine is discovered, there will be a rebound in the real estate economy, perhaps a rise in sentiment then?
I think there's every reason to believe that if when the vaccine is found, we're all going to be, very happy, and that will lead to a rebound in sentiment. And I think, this is why, if you look, people talk about the recovery next year. We expect to see growth rates globally. Okay, so the IMF put out forecast expecting a 5% contraction in 2020. Their expectation is for a rebound of 5% next year. Much higher growth next year than we would have otherwise had, gets us back to where we were. So I think, yes, there's going to be huge, that will be a positive. You know, people will think, and just look at stock markets around the world. Look at the US stock market trying to discount that positive sentiment even now. You know, I think my point really is that beyond that kind of initial bounce in sentiment that we'll obviously get when a vaccine comes along, you know, the underlying story that we had even before COVID about fiscal sustainability in the context of lower oil prices is one that hasn't changed at all.
Well, let's look at policy responses. The UAE and Saudi have issued a number of policy responses over the last 7 months. Do we expect to see more policy responses this year, especially considering the push that they have been doing to grow and diversify their economies in 2020?
I mean, yes. I wouldn't want to sort of guess what it is that may be announced. I mean, I have no doubt that we're going to see responses. I mean, I think, again, I don't think it's going to necessarily involve opening the fiscal taps. But there are many supply side measures, new visa rules and requirements. There may be an addressing of that, which I think would be really important, or business regulations that make it easier. And so I think I do expect to see a lot of these positive responses. But I'd also think, you know, the fog needs to clear. I wouldn't want to be a policymaker right now guessing what's going to happen. And I think I would try and, as I said, wait for the fog, the mist to clear, and then sort of take it from there. So difficult. I'd be reticent to get into knee-jerk policy making. That's yeah.
Well, let's look at the commercial market. Simon, I'll just bring you in here as well. So currently there's a debate around whether the office sector is under threat. Is this a fair statement? And will we start to see larger multinational businesses downsizing here in the region in favor of smaller offices, opting for more of a hybrid office home approach?
I mean, I think, excuse me, I think one of the things that we're seeing is that, and I think, as I mentioned, the way that we use our space is going to change. And it may well be that in addition to a corporate hub, we do have a sort of a number of spokes in different geographies. But the most important thing I think that we have to think of, particularly where we're sitting from a geographical point of view, is that Dubai, whether it be Abu Dhabi, whether it be the Kingdom, we are the hub between Asia, Africa and Europe. And I think a lot of the global corporates will create and consolidate that hub, and we'll continue to see a strong office environment. The other thing that's most important as well is, and I think that's something you've talked about, policy, but I think we have to look at the regulations. And as a foreign occupier and a global corporate, they need to look at the regulatory environment upon which they're based and where their headquarters is. And you know, Dubai and Kingdom have got quite robust, particularly the likes of DIFC and others, where you know they've replicated some of the laws and the operating requirements that have happened elsewhere in the world. So I think there will continue to be strong office demand in those locations. I think the secondary and tertiary markets and again we both touched on it, but you know these were challenges before COVID, and I think there'll continue to be challenges even with a vaccine. Whether people work from home, whether people work remotely, all of those trends that we've highlighted and talked about, there is still going to be the social interaction, the business growth, the collaboration required. And so I think, you know, there will always be a demand for offices. I can't see, you know, the next generation or the generation after looking in books to try and find out, in the old days, did people really go into a building to work? I don't think we're at that point. You know, there will still be a strong demand. And the way we get the best from our employees is to bring them all together and collaborate. So I think, you know, I don't see the end just yet.
Mm-hmm. Well, a lead on from that, investors who have a focus on the commercial sector, especially here in the region, what are your thoughts on whether they will re-examine their investment strategies within the second half of this year and perhaps in 2021?
Yeah, the capital markets is always challenging. And I think one of the things that Dr. Chris mentioned, which was very important, is the difference between supply and demand. And when we look at the investment market, And there is very, very limited institutional grade investment product in the investment market. So those that are seeking long income and investment grade is what I mean here is, maybe a strong covenant with a long income flow. So secure income. What there is a significant shortage of that. And when we look at, the local and the regional capital funds that have all got capital to deploy, the amount of money to spend is still there. The problem is the assets required within that space are missing. So I think that demand is going to continue. It is having a pressure on yields, which in fact is making some of our real estate look comparable price-wise to elsewhere in the world. It is a challenge for the international funds because we're often on many documents seen as an emerging market. Yeah, unfortunately, the returns that one would get from high quality real estate are mature market returns. So there is an imbalance there. But I do think that, the weight of capital looking for long-term, good quality institutional income remains. So on that basis, I think the challenge is just finding it. So I don't think that will change.
Okay. Well, different real estate asset classes have been impacted to various different degrees. Post-crisis, what is the investment focus long-term? Which asset class do you think you'll see more potential?
Yeah, I wish I had that crystal ball to be able to give you that answer. But I think one of the most important things in that comment is that you're right, that every asset class has been impacted in a slightly different way. And so perhaps the most important thing to say is, let's take a step back and look at people's portfolios. Let's look at their investment risk and their investment criteria going forwards. If you are an investor that has 100% of your investment product in offices or high street retail or shopping malls, then clearly the impact of this on you is single asset or single geography based. So perhaps the most important thing is, let's look at diversification of either asset or geography or sector. Let's look at how we can create a more balanced portfolio that does give, not a hedge, because it's almost difficult to hedge against what's happening, but let's give a more structured approach to growing the portfolios going forwards. And then we can manage adjustments up and down in different asset classes. But the most important thing is there's not one size fits all. So even you take the term office, there's a significant difference between an office in Al-Quoz, without any disrespect, to an office in DIFC, or a warehouse in Dubai South compared to a warehouse in Al-Quoz, or something in King Abdullah Financial District compared to something in King Fahd Street in the Kingdom. So we have to just look at it asset by asset and say, actually, it's the cash flow, the security of that cash flow, not the asset itself, that's going to drive the investment decisions.
Mm-hmm. Well, we got an interesting question from the audience around the future of physical retail and looking at how e-commerce is changing the face of physical retail. What are your thoughts around this?
I mean, there's been lots of publications and reports and stories. And in fact, we ourselves have published many reports around that. I do think that despite the fact that it is easy at the moment to press a button and order something and it arrives, I think, and it's quite a novelty for some people to get certain things delivered. I do think, there is still a large, significant group of the population that like to go and see it, touch it, particularly here where, and again, I try to say this cautiously, you're always a little skeptical, perhaps, of some of the things that you see online. I think there's still no, there's no substitute for trust and going in and trying something and, and seeing how things look or feel or anything else. I mean, cars, you look at, the transaction of cars. Tesla, obviously, you can buy a car without physically going to the showroom. Whether we would or wouldn't, it's the experience of doing that transaction that still drives people through that, that retail space. And I mentioned, the growth in experiential retail or edutainment, all of these different things. People are going to shopping malls for more than just to buy something. It's the whole sort of entertainment, the whole experience, the F&B, the whole thing. So I think, retail will always remain a big component of our economy. I do think things are changing. It may well be that the way shops operate change, but again, e-commerce itself does bring positivity to the real estate markets, whether it's additional warehousing, whether it's, additional facilities to, logistics hubs. So there are positives and negatives, but, it would be expected for us to evolve. Every high street, every shopping centre globally has evolved when market trends have changed, and I don't think we're any different just now.
Mm-hmm. Well, Chris, let me ask you this. It's a question from the audience. Does oversupply continue to pose a challenge in the residential space, especially here in Dubai?
Yes. I mean, I think obviously that we do have various forecasts for the addition to supply this year and next year. And I think it's, we could be looking at 5% plus, this year, next year, something in that range. It all depends on obviously how developers react to what's going on. But I do just, want to reiterate this sort of point, which is that in our own model, it's really demand that actually is far more an important variable, an explainer or an estimator of each year's change in the real estate price. And I think just, if we think anecdotally, it's often those periods where we see really rapidly rising prices invariably are periods where we also see rapidly rising supply. It's a very demand-driven market, not just here, but all around the world. So, to be honest with you, I worry less about supply addition and much more about demand and the underlying conditions of aggregate economic demand. So it's a problem, but it wouldn't be a problem if all of a sudden there was a huge change in sentiment and the economy was growing at 6% again.
Mm-hmm. Well, we got this question from one of our audience members. What are your recommended actions for GCC to help improve demand, if there are any?
Recommended yes. I mean, okay, so let's talk about residential. I mean, I think, there is a high proportion of expats in this country. Let's take the UAE. I mean, it varies across the region, but I think on anything from 50% to 90% of populations across the GCC are expats. And obviously, if you want people to feel more confident in the real estate market, they probably have to have more confidence in their ability to stay, in the country. And I think that is. I think to be very fair, visa reform is something that I think the governments across the UAE and the Gulf are extremely aware of, and it's something that they're looking at and addressing, and they've already made some changes to regulations. I wouldn't be surprised if more regulations come on visa, and I think it's a really important part of recognizing. The sort of, I think that many people would ask themselves, for instance, will I buy or won't I buy? And I think there's probably more demand that would come from more certainty over residential status. But, we have to remember that a lot of progress has been made. It's not going to happen overnight. These are relatively young countries. I think let's not ask for too much because I think that would just be unrealistic. But I think that the process has already started and the questions are being raised.
I think the other thing I would just add there is, and we look at it from a financial point of view, and I agree, you want to make sure you've got certainty over your ability to reside or use the property for the beneficial use upon which you bought it. But if we look at the cost points of real estate, and let's say we are in a position where we want to deploy some, residential capital, the amount of equity one might have to put in before bank debt or before some other structured finance. I mean, to be honest, that equity is often quite a big chunk as a percentage, depending on whether you buy off plan or whether you buy an existing product. The amount you can get in a local mortgage varies. And I think the challenge comes when actually people take a step back and say, what, I could probably deploy that same amount of equity in a investment product, as a flat, an apartment, a townhouse, whatever they might be, somewhere in one of the second cities in a country that I know, my own base, as it were. I've got ownership. I can see potential capital appreciation. I've got clarity of ownership. And so I think the entry points are quite difficult from a financial point of view. And the problem is we compare everything to our own countries. We say, OK, I have to put in $300,000 of equity to get what I need, just as an example. And then we think, actually, I could buy 2 apartments in downtown X for $300,000 and get a 4% return. It's not great, but it gives me a 4% return and some ownership. Maybe I'll just do that and pay rent. And I think, in a period of market uncertainty where people aren't necessarily sure the duration of their employment or what their remuneration structures look like, I think it's difficult to convince people to deploy significant sums of capital. But I do think I agree with all the comments about the visa, the regulations. And I think there's also a softening in sentiment from developers, where they're working with potential purchasers to try and bridge that gap, bridge that amount of equity that you need to enter into that market, and try not to make it too difficult to get on the housing ladder here. So I think I agree, I think there's a lot more demand than we see. I think there's just a lot of barriers that we need to overcome first. Yeah,
and actually, I just rejoined to Simon's point on, I mean, you only have to look at the impact that mortgage reform, if you like, or the establishment of a sort of viable mortgage regime has had in Saudi Arabia to understand the impact that can have on sentiment in the market. Now, that was more to do with, obviously, with Saudi nationals, but if you just look at the expansion of mortgage lending in 2019 and the impact that had on residential prices in Riyadh, it just gives you an indication of how financial reform can really impact demand. So absolutely, yeah.
Well, thank you. I'm afraid that's all the time we have for today. Thank you to our speakers, Simon Townsend, Senior Director and Head of Valuation and Advisory Business at CBRE, Dr. Christopher Payne, Chief Economist at Peninsula Real Estate. If you would like more news and developments on the local, global real estate markets, please visit cityscape-intelligence.com, where a recording of this webinar will also be available. Thank you for joining us today. If we didn't get to your questions, I'm sorry. We'll try to personally write to you after this. And until next time, goodbye.
Thank you.
Bye-bye.